In aviation, we call it a position report. You're already in the air, the flight plan is filed, the route is set, and when you reach a mandatory reporting point, you check in and confirm your position, your altitude, your estimate to the next point, and your fuel state. You're not changing course, you are confirming that the plan is still intact. That is what today is. Back on day 11, I ran a full thesis check on BlackRock after a full year 2025 results. My conclusion was simple. The thesis was improving. I gave you three key numbers to write down. 14 trillion in AUMs, 698 billion in net inflows, and $48.09 in adjusted EPS. I also gave you 6 things to watch in Q1 2026 arrived. And I told you exactly when to check it, April 14th before the bell. This is Captain Pierce. Welcome back to SkiesCapital. Think clearly, invest better. Let's open with the new position report. AUM's $13.9 trillion, Q1 net inflows at $130 billion, Q1 revenues at $6.7 billion. Now, let's go. Let's start with the scoreboard because the numbers tell the story. The adjusted EPS came in at $12.53. The estimate was $11.48. That is a beat about 9%. And that matters because it is now the 5th consecutive quarter BlackRock has beaten consensus estimates. 5 in a row. That is not noise. That is a business consistently performing above what analysts model. Revenue came in at $6.7 billion, up 27% year over year. The estimate was about $6.42 billion, another beat. Now, the number that looks a little different on the surface is AUMs. And it comes in at $13.9 trillion on March 31, down slightly from the $14 trillion we saw at the year-end 2025. And I want to address this directly because I know what some of you are thinking when you see this number. The dip in AUM was entirely market-driven. The tariff shock and the macro volatility early in 2026 compressed equity market values during that quarter. But here is the proof. Net inflows were positive $130 billion. Clients were still sending money in. So the AUM decline came from market price moving, not from clients leaving. That is completely different signal. Weather, not structural. Now, let's get into the most important number in the whole report. Organic base fee growth. It came in at 8% for the quarter and 10% over the last 12 months. Back in day 11, our threshold was 6% or better. BlackRock cleared it with a meaningful margin. And Larry Fink said on the call that this 8% organic base fee growth was the highest first quarter organic base fee growth in 5 years. And the rest of the data table fills in the picture. Adjusted operating margins came in at 44.5%, up 130 basis points year over year. iShares pulled in $132 billion in Q1, a record first quarter for the ETF franchise. Technology and Aladdin ACV grew at 14% year over year, and the $5.73 quarterly dividend was paid exactly as promised. So the scoreboard here is pretty clear. Earnings beat, revenue beat, inflow stayed strong, fee growth stayed strong, and the AUM dipped was market driven, not thesis driven. Let's look at the AUM chart because context is everything here. You can see 6 quarters of history. AUM climbed from 11.6 trillion at the end of 2024 to 12.5 trillion and then 13.5 trillion in Q3 of 2025. And then at the end of 2025, 14 trillion. Then came Q1 2026, 13.9 trillion, a small step back. So the question I asked myself when I saw this number was simple. Did the engine stall or did we just hit turbulence? The answer is in the flows. BlackRock took in $130 billion of positive net inflows in Q1. Over the last 12 months, clients have sent BlackRock $744 billion in new assets. That tells you the engine did not stall. The plane flew through turbulence and kept climbing. The AUM's dip came from the market giving back some of what it already given, not the clients voting with their feet. And the call card on the right makes it clear. 13.9 trillion AUM, $130 billion in Q1 inflows, 8% base fee growth, the highest first quarter in 5 years, and $132 billion in iShares inflows, a record first quarter for ETF platform. One more point I want to make clear. That $744 billion in trailing 12-month inflows is actually above the $698 billion in full-year record BlackRock posted in 2025. So no, the engine did not stall.
The route is still intact. This was turbulence, not a change in direction.
Now, this is the slide I've been building toward since day 11. Back then, I gave you 6 specific things to watch. Now, we have the answers. Let's go through them one by one. Checkpoint 1, organic base fee growth at 6% or better. It came in at 8% for Q1 and 10% over the last 12 months. That is the highest first quarter organic base fee growth in 5 years. Confirmed. The threshold was not just met, it was cleared by a solid margin. And more importantly, it tells you the organic momentum from Q4 2025 carried into Q1 2026. Checkpoint 2, private capital fees ramped. HPS and GIP increased their contributions. BlackRock posted $9 billion in private capital net inflows for Q1. HPS contributed $121 million in performance fees in a single quarter. Private credit and infrastructure are both showing real demand. Confirmed. The transition story is not theoretical anymore. It is producing real fee revenue. Checkpoint 3, Aladdin and Preqin integration. Technology ACV grew 14% year over year. Preqin contributed about $65 million in revenue in its first full quarter on the books. Technology services revenues grew at 22% year over year. Confirmed. The integration is tracking, the revenue is showing up, and the direction is consistent with management's long-term ACV growth targets. Checkpoint number 4. iShare competitive position. Did the market share hold? iShares brought in $132 million in Q1 inflows, a record first quarter for the franchise. Active ETFs alone surpassed $110 billion in AUM. The ETF business delivered double-digit base fees growth, and Larry Fink said on the call, iShares net base fees are now double what they were this time last year. Confirmed. And then some. Checkpoint 5, capital allocation discipline. BlackRock repurchased $450 million in stock in Q1, which keeps them on pace with the $1.8 billion full-year plan management committed to. The $5.73 dividend was paid exactly as promised. No surprises, no changes, no walking back commitments. Confirmed. Checkpoint 6, revenues versus estimates of roughly $6.6 billion. Actual revenues came in at $6.7 billion. Adjusted EPS came in at $12.53 versus its estimated $11.48, about 9% beat. That makes 5 consecutive quarterly beats. Confirmed. And revenue beat was broad-based, not driven by one line item. So here's the scoreboard. 6 checkpoints, 6 confirmations, no missed calls. That's a position report. Now, let's look at both sides. What did Q1 lock in, and what am I still watching? On the confirmation side, first, organic base fee growth came in at 8%. The highest first quarter in 5 years. That tells me the acceleration we saw in Q4 is not a fluke. 2 consecutive quarters, strong organic fee growth is a pattern, not an outliner. Second, iShare posts a record first quarter. That franchise is not just holding its position, it is strengthening it. When the market gets volatile, flows into low-cost liquid ETFs tend to accelerate, and BlackRock is the obvious beneficiary. Third, operating results were strong. Revenues grew 27% year over year. Operating income grew 31%. Adjusted operating margins expanded by 130 basis points to 44.5%. That is an operational leverage story showing up in real numbers. Revenue growing faster than cost. Fourth, private capital infrastructure continued to show structural demand. HPS generated $121 million in performance fees in a single quarter, which is a strong first read on what the business can contribute. Management framed the demand as structural, not cyclical, and noted the spreads widened 25 to 50 basis points above Q4 levels, which proves the economics of the new deployment. Now here's what stays on my watch list going into Q2. The move in AUMs from 14 trillion to 13.9 trillion was a market driven, not a flow based driven. But if the equity markets stay under pressure into Q2 and the macro backdrop is still volatile, that headwind on base fee revenue can compound. So I want to watch where AUMs sit on June 30th. Second, institutional index saw $35 billion in net outflows in Q1. These are lower fee mandates, so the direct impact on base fee revenue is modest.
but it is still a number worth tracking. If the outflow accelerates, it deserves a closer look. Third, the broader macro environment remains the biggest vulnerable. Tariff uncertainty, geopolitical pressures, and potential credit stress have not gone away. BlackRock is not immune to markets. What we do know is when it hits turbulence, the engines keep running. And finally, valuation. So the business is executing, the thesis is holding, but the market is not giving you much room for error. All right, position report filed. Here's where we land. Update thesis status still improving, not just holding, improving. And I want to be precise about what that means. Back on day 11, my verdict was improving. After Q1, my verdict is still improving. That means the body of evidence supports the thesis got stronger this quarter, not weaker. Here is what moved in the right direction. First, organic base fee growth hit 8%. Second, the private market pivot is now producing real, measurable fee revenues. Third, iShares posted a record first quarter while the markets were volatile. Fourth, operating leverage expanded margins by 130 basis points. And fifth, capital returns came in exactly as promised. $450 million in buybacks and a $5.73 dividend paid. Management is doing what it says it would do. Now, what I'm monitoring into Q2, AUM's recovering. Does the 13.9 trillion move above 14 trillion as the market stabilizes? Institutional index outflows. Do they continue and do they begin to matter for base fee revenue? Organic base fee growth. Can BlackRock sustain a 6% or better through Q2? Or was the Q1 a high watermark? And always, valuation remains the main risk, not the business. The price still reflects optimism. The business is delivering on that optimism, but there is not a wide margin of safety if something changes. So the bottom line is this. The Q1 position report is clean. The engine did not stall. It delivered. The thesis continues to improve. Valuation remains the principal risk, not a business quality. Still on course. Management called this one of the strongest starts to a year in BlackRock's history. Clients awarded the firm $130 billion in net inflows in the first quarter. That drove 8% organic base fee growth, the highest first quarter reading in the last 5 years. Sit with that for a second. Not we had a good quarter, not we are pleased with the results. One of the strongest starts to a year in the company's history, coming right after a record full year in 2025. That is the trajectory. Here's the thing about a position report. You file it because you need the truth about where you are, no matter what it says. And today, the truth is simple. We are still on course. 6 checkpoints set on day 11, 6 confirmed. That is not luck. That is a business executing against a stated strategy. And when a business you own does exactly what management says it would do in a volatile market, you do not overcomplicate it. You acknowledge the facts, update the thesis, and keep flying the plan. BLK thesis improving. 6 of 6 checkpoints confirmed. What I'm going to be watching for Q2. AUM's recovering above 14 trillion. Organic base fee growth sustained above 6% or better. Any macro pressure affecting institutional flows. Private capital conditions in a more volatile credit environment. And valuations versus fundamentals. That is the Q1 2026 thesis check on BlackRock. This is Captain Pierce with SkiesCapital. Think clearly, invest better. This is for educational purposes only, not investment advice. Do your own research, make your own decisions. I'll see you on the next one.